Welcome to Smart Stock Watch, your go-to channel for in-depth financial analysis. Today is December 2nd, 2025, and we're diving into Scotiabank's fourth quarter earnings report. Joining us is John, senior analyst from Smart Stock Watch. John, thanks for being here.
Thank you for having me. Scotiabank has just released their Q4 2025 earnings, and there's a lot to unpack, from their net income growth to strategic initiatives across various segments.
Revenue and profitability overview. Let's start with the top line. Scotiabank reported a total revenue of $9.8 billion for Q4 2025, which is a 15% increase compared to the same quarter last year. John, what are the key drivers behind this growth?
The revenue growth is primarily driven by higher net interest income and non-interest income. Net interest income increased by 13% due to a higher net interest margin and loan growth. Non-interest income also saw a 17% rise, thanks to higher wealth management revenues and trading-related revenues.
And how did this impact their profitability?
Scotiabank's net income for the quarter was $2.2 billion, up from $1.7 billion last year. The adjusted earnings per share came in at $1.93, significantly beating the forecast of $1.33 from 4 analysts. This reflects strong operational performance across their business lines.
Segment performance and strategic initiatives. John, can you break down the performance across Scotiabank's different segments?
Absolutely. Canadian banking delivered earnings of $3.4 billion, though it faced challenges with higher credit losses. International banking saw a 2% increase in earnings to $2.8 billion, driven by revenue growth and disciplined expense management. Global wealth management was a standout, with a 17% increase in earnings, fueled by higher mutual fund fees and brokerage revenues. Lastly, global banking and markets reported a 30% increase in earnings, thanks to strong capital markets performance.
It seems like Scotiabank is making strategic moves across its segments. What initiatives are they focusing on?
Scotiabank is prioritizing value over volume, optimizing its portfolio, and enhancing operational efficiencies. They're also focusing on regionalizing activities and simplifying their organizational structure, which should support long-term growth.
Risk management and capital position. Risk management is crucial for any bank. How did Scotiabank perform in this area?
Scotiabank reported a provision for credit losses of $1.1 billion, up from $1 billion last year, reflecting business growth and credit migration. However, their capital position remains strong, with a CET1 capital ratio of 13.2%, and they maintain robust liquidity metrics, with a liquidity coverage ratio of 128% and a net stable funding ratio of 160%.
These figures suggest a solid foundation. How does this position them for future growth?
With strong capital and liquidity positions, Scotiabank is well equipped to pursue growth opportunities and withstand potential economic headwinds. Their focus on optimizing capital deployment aligns with their strategic goals.
CEO's perspective and future outlook. Let's hear from the leadership. What did Scotiabank CEO Scott Thomson have to say about the results and future outlook?
Scott Thomson described 2025 as a very positive year for Scotiabank. He highlighted the bank's strengthened balance sheet, improved loan-to-deposit ratio, and increased return on equity. Looking ahead to 2026, the focus will be on achieving their medium-term objectives, with all business lines expected to continue reporting earnings growth.
It sounds like Scotiabank is entering 2026 with momentum. What should investors keep an eye on?
Investors should watch how Scotiabank executes its strategic initiatives, particularly in optimizing its international footprint and enhancing operational efficiencies. Their ability to maintain strong capital ratios while pursuing growth will be key.